Okay, let's unpack this. Welcome to the deep dive.
Hello.
Today we're getting into something that sounds maybe a bit heavy, maybe takes you back to math class, the option Greeks.
Yes. Theta, delta, gamma, Vega, rho, the whole lineup.
Exactly. And look, those names can sound intimidating, no doubt, but we've been looking at this YouTube source that does a great job, really, of demystifying them.
It does. It makes it clear these aren't just theory. They're, actively shaping auction prices every single moment.
Right. So that's our mission today. We're pulling out the core ideas from that source. What are these Greeks? Why should you care if you're trading options? And crucially, how do they actually, work? How do they push those premiums up or down?
We want to turn that potentially confusing jargon into something, well, useful, practical.
Think of it like the hidden forces behind the price tag. Okay, so let's start with a classic situation, one the source highlights. Imagine you're a new trader.
Okay.
You buy a nifty call option, say the 18,000 strike, pay 120 premium. You think Nifty's going up?
Makes sense.
But then, nothing. Nifty just stays flat, right at 18,000. Later, you check your position, and your 120 option is suddenly worth like 100. The market didn't even move against you. So where did that euro vanish to?
That's your introduction to Theta.
Theta.
Theta is time decay. Pure and simple, it's the measure of how much an option's value decreases just because time is passing, because it's getting closer to expiring.
The clock is ticking, literally eating your premium.
Exactly. And the closer you get to that expiry date, that's every Thursday for Nifty and Book Nifty index options, or the last Thursday of the month for stock options, the faster this decay happens.
Oh, it accelerates.
Oh, yeah. The source gives a good feel for it. Maybe on Friday, the decay is small, just a few rupees.
Yeah.
But come Wednesday, Thursday, boom. It can fall off a cliff if the underlying hasn't moved enough in your favor. That premium can just melt away to zero by expiry.
Okay, so that's a huge takeaway. If you buy an option, Theta is constantly working against you, draining value.
It is. It's like paying rent on that potential profit.
Yeah.
But if you sell an option,
then it's your friend.
precisely, you collect the premium up front.
Yeah.
And if time passes and the option decays, that decaying premium becomes your potential profit. Theta works for the seller.
Got it. So Theta explains the flat market scenario, but okay, what if the market does move your way? Back to that 18,000 call example. Nifty does go up, say, 100 points to 18,100.
Right.
How much should your premium actually increase, and what's the profit look like then?
Now we're talking about delta.
Delta, okay.
Delta tells you how sensitive your option's premium is to a change in the underlying asset's price. Specifically, how much the premium should change for every 1-point move in the underlying.
So Nifty moves 1 point, Delta tells me how much my option price changes, like in rupees.
Exactly. Delta is expressed as a number between 0 and 1. At the money options, where the strike is right near the current price, they typically have a delta around 0.5.
Half a point change in premium for a 1-point move in Nifty.
Roughly, yes. In the money options, those already profitable have deltas closer to 1. The deeper in the money, the closer to 1. And out of the money options, the ones that need the price to move to reach them, they have deltas closer to 0, maybe 0.1 or even less if they're far out.
Okay, the source had some good examples here. Let's take the at the money one first. 18,000 call, Nifty at 18,000. Premium was, say, 100 in this example from the source. Delta is 0.5. Nifty jumps 100 points.
Okay, so that 100-point Nifty move multiplied by the 0.5 delta, that means the premium should increase by 50.
Right, so the honor premium becomes 150.
Correct.
And for one lot, that's 50 shares in Nifty. So 100 premium costs 5,000. Now it's worth 150 times 50. 7,500. That's a 2,500 profit.
Makes sense. Now let's contrast that, like the source does, with an out-of-the-money option.
Yeah.
Say you bought the 18,100 call when Nifty was still back at 18,000.
Okay, further out.
Right. Let's imagine for comparison in the source example, it also cost 100 premium. But because it's OTM, its delta is lower. Let's say 0.4.
Lower sensitivity, okay. So Nifty still makes that same 100-point jump to 18,100, but with a 0.4 delta.
That means the premium increase is only 100 points times 0.4, which is 40.
Only 40. So the 100 premium goes to Olundero.
Yep. And on that one lot, your 5,000 investment is now worth 140 times 50. That's 7,000. So the profit is 2,000.
Wow. Okay, hold on. Same 100-point move in Nifty, same initial premium cost in this particular example, but the profit is 500 less per lot just because the OTM option had that lower delta.
That's the power of delta right there.
Yeah.
It shows your leverage. Higher delta, more bang for your buck on favorable moves, but also more pain if it goes against you.
And the OTMs, yeah, they might be cheaper usually, but that low delta means you need a much bigger market move to get the same kind of percentage pop in value.
Exactly. Less sensitive. Okay, so delta measures that sensitivity.
Yeah.
But hang on, that sensitivity itself can change, right?
Uh,
Like in that example, the 18,100 call started OTM with a zero point 0.4 delta when Nifty was 18,000. But when Nifty hit 18,100, that option became at the money.
and its delta would move up closer to 0.5.
Right. So what causes the delta itself to change like that?
So, okay, good question. What is that?
That's gamma.
Gamma. All right, the third Greek.
Gamma measures the rate of change of delta. How much does delta itself change for every 1-point move in the underlying?
So it's like the acceleration. Delta is speed, gamma is acceleration.
That's a great way to think about it, the delta of delta.
Hmm.
As Nifty moved 100 points in our example, the delta of that 18,100 call changed from 0.4 to 0.5.
Yeah.
That increase of 0.1 in delta,
Yeah.
that's related to the gamma.
I see. So delta tells you your sensitivity now. Gamma tells you how quickly that sensitivity is likely to change as the price keeps moving.
Precisely. Higher gamma means delta changes faster. This is especially true for options that are near the money or close to expiry. Gamma can really amplify the effect of delta in those situations.
Okay. Theta for time, delta for price sensitivity, gamma for the change in that sensitivity. Got it. Now, the source shifts gears a bit away from just price and time and towards market mood. Volatility.
Yes, volatility, the choppiness, the expected size of future swings. How does that impact option prices?
Right. How does it?
That's where Vega comes in.
Vega. Okay.
Vega measures how much an option's premium is expected to change for every 1 percentage point change in the underlying asset's implied volatility, or IV.
Implied volatility. That's the number you often see listed next to options, right? In the option chain.
That's the one. FOVI isn't historical volatility, it's what the market is implying or expecting about future volatility. It tends to go up when people expect big news, earnings, elections, uncertainty.
So market anxiety basically pushes IV up.
Pretty much. Higher fee means the market is pricing in bigger potential price swings.
And Vega connects that expectation to the options price.
Yes. When 5 increases, the source mentioned examples that IV jumping from maybe a quiet 9-12 range up to 20 or more, Vega makes option premiums go up.
Why, though?
Because options give you the right to benefit from a big move. If the chance of a big move, higher volatility, increases, that right becomes more valuable. So sellers want more premium for taking on that increased uncertainty, and buyers are willing to pay more for the increased potential.
Makes sense. And when AVI drops?
Premiums tend to shrink because of Vega.
So unlike Theta, Vega seems to favor the option buyer. If you buy an option and then volatility spikes.
Your premium gets a boost from Vega, absolutely.
Yeah.
Even if the underlying price hasn't moved much yet, and it works against the seller. If you sell an option hoping for calm and then IV shoots up, the option you sold gets more expensive, which is bad for your position.
Interesting. The source mentioned maybe using IV levels as a signal, like
Yeah.
sell options when IV is super high, buy when it's super low.
It touched on that idea, yeah. High 5 might suggest volatility is likely to fall, good for sellers. Low IV might suggest it's likely to rise, good for buyers. But of course, that's just one piece of the puzzle. It has to fit with your overall view.
Sure. Okay, fascinating stuff. That leaves one Greek from the list, rho. The source seemed to say this one is less critical, especially here in India.
That's generally the take, yes. Rho deals with interest rates.
Wow, okay.
It measures how much an options premium should change for a 1 percentage point change in interest rates.
And what's the basic link?
Generally, the source points out higher interest rates tend to make call option premiums slightly higher. That's positive rho. And they make put option premiums slightly lower, negative rho. It's tied to the cost of carrying the underlying asset, essentially.
But the key point from the source was, for most option traders, especially short-term ones in the Indian market, the day-to-day impact of rho is pretty minimal.
Yeah, that's the practical takeaway here. Compared to the constant ticking of theta, the price sensitivity of delta and gamma, or the swings from Vega caused by changing volatility, rho's influence is often negligible in this context. It's good to know it exists, it's part of the formal pricing models, but it's not usually the driver of your P&L.
Right. Good to know. Okay, so, wow, we've covered a lot based on that source. We've unpacked theta, time decay, delta, price sensitivity, gamma, delta's acceleration, Vega, volatility sensitivity, and rho, interest rate sensitivity.
And the big message really from the source material is that getting your head around these concepts, even if they seem a bit much at first, is kind of essential if you're serious about trading options. It moves you beyond just betting on direction.
Yeah, it helps you understand the why behind price changes. Why did my option lose value even though Nifty was flat? Why did this option gain more than that one? It's these Greeks working under the surface.
Exactly. It gives you, the learner, a much fuller picture of the dynamics at play.
It definitely does. So maybe a final thought to leave you with, building on this. If you have all these Greeks acting on your option position at the same time, theta constantly nibbling away at the value, while maybe delta is adding value because the price moved right, and maybe Vega is also adding value because volatility just jumped, what does that complex interplay tell you?
That's a good point. All these forces working together, sometimes against each other.
Yeah. What does that complexity suggest about how important it really is to, well, truly understand the instrument you're trading before you put your money on the line? Something to think about?